Good day, Dr. Zalaila. My name is Prashina Balakrishna with the matrix number of S66692. Today, I'll be presenting about my individual assignment for Audit 2, which is about key audit matters. First, I will touch about the topics, which is firstly, key audit matter, second, ethical issues, and third, discussion, which where I will touch on how ethical issues arise from key audit matters and the prevention strategies for all of these key audit matters. This presentation's background is about key audit matters, which are issues that auditors identify as requiring significant judgment and as regarded as the most critical aspects of a financial audit. These issues are included in the Independent Auditor Report to improve transparency in the audit process and to highlight areas with higher risk or complexities. By including KAMs, stakeholders can gain better insights into significant areas of the audit and the company's financial reporting. However, KAMs also have implications for the integrity of financial reporting. If these complex issues, such as revenue recognition, asset impairment, or financial instrument valuation, are not properly addressed, they can lead to misstatements or manipulations, potentially compromising the accuracy and reliability of financial statements. Therefore, while KMs enhance transparency, they also underscore the necessity for ethical behavior and meticulous examinations by both auditors and management to uphold the integrity of financial reporting. This is the Independent Auditor's Report which I have acquired from the Golden Land Berhad Annual Report for the year 2023. The first key audit matter identified is impairment of trade and other receivables. The ethical issue for this key audit matter is the audit team may face pressure from management to understate impairment losses on trade and other receivables to present a more favorable financial position. And how these ethical issues may arise is by independent threats. As the assessment of impairment losses involves judgment and estimation, this provides room for management bias. And the prevention strategies for this ethical issue is involvement of an independent quality control reviewer or an external reviewer to evaluate audit work as a third party who is not related to the company, and management may strengthen findings regarding impairments to confirm objectivity. The second ethical issue identified is, to suit management's desires, auditors might overlook or selectively interpret data about the recoverability of trade and other receivables, which could mislead stakeholders. And how this may arise is by, auditors may also intentionally or unintentionally overlook inconsistencies in management's assumptions or fail to obtain sufficient evidence about recoverable receivables, which leads to misstatement in financial statements. The prevention strategy for this ethical issue is require detailed and complete documentation of audit evidence, including justifications for significant rulings. This ensures accountability and facilitates assessment by higher authorities. The second key audit method identified is revenue recognition for property development, and the ethical issue identified is management may pressure auditors to recognize revenue prematurely to meet earnings targets or improve the company's financial performance. Second, management may also manipulate transaction prices allocation to different projects, which could artificially boost revenues for underperforming projects. And how this may arise, you may ask, is management may manipulate assumptions such as progress billings or provide incomplete data to the auditor. This will make auditors feel more compelled to adhere to management assertions, and the prevention strategies are, first of all, they should create a strong internal control such as separate team to verify project status and guarantee these cost estimates. Secondly, disclosure of any significant estimates or assumptions in financial statements as well as thorough accounting processes for revenue recognition is required. The second ethical issue is auditors may face conflict of interest if they have a close relationship with their client or if the significant non-audit services are provided, such as tax services. This may lead to compromised objectivity in evaluating revenue recognition practices. This may arise as in order to preserve the client relationship, the audit firm may hesitate to challenge the management about aggressive revenue recognition techniques, which is a breach of ethical standards. How this may be prevented is by the implementation of strict policies to ensure that firms providing audit services are not involved in non-audit services for the same client. This segregation of audit and non-audit services reduces the risk of conflicts. Second is to enforce the rotation of audit partners for clients to minimize familiarity threats. The third key audit method is impairment of amounts due from shareholders. Ethical issue is management may purposely conceal or distort important facts regarding the financial standing of subsidiaries. This may result in failure to reveal significant risks or uncertainties related to the recoverability of the amounts owed. Management might provide incomplete financial data or overly optimistic projections about subsidiaries' abilities to repay, leading to understated impairment losses. Due to time restrictions or lack of skepticism or desire to avoid controversy, Auditors may purposely or unintentionally fail to question this completeness and appropriateness of the information supplied. How to prevent this is by cross-checking information supplied by the management with information from other sources, such as market reports, outside confirmations, or independent assessment of the subsidiary's financial health. Secondly is to establish strict protocols to guarantee that the financial statements contain adequate disclosures. This entails taking in depth with the audit committee about the uncertainties and confirming adherence to the pertinent accounting standards. The second ethical issue for key audit number 3 is management may pressure auditors to minimize impairment losses to represent the financial position of the company in a more favorable way. This may arise due to management giving inaccurate or biased information regarding the financial standing of subsidiaries or future cash flow. Auditors may feel compelled to align with the management views to avoid disputes. The prevention strategies are require independent assessments of future cash flows or financial sustainability of subsidiaries, obtain external evidence or hire experts such as market data or engaging independent specialists, and implement detailed audit procedures to evaluate reasonable of assumptions used in impairment calculations, including stress testing scenarios and verifying supporting documents. The second ethical issue for key audit number 3 is management may pressure auditors to minimize impairment losses to represent the financial position of the company in a more favorable way. This may arise due to management giving inaccurate or biased information regarding the financial standing of subsidiaries or future cash flow. Auditors may feel compelled to align with the management views to avoid disputes. The prevention strategies are require independent assessments of future cash flows or financial sustainability of subsidiaries, obtain external evidence or hire experts such as market data or engaging independent specialists, and implement detailed audit procedures to evaluate reasonable of assumptions used in impairment calculations, including stress testing scenarios and verifying supporting documents. That's all from me. Thank you so much.